Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit subscribe for the latest. Well, it's been an eventful day in the markets as Jerome Powell, the Fed's chairman, just confirmed that rate cuts are on the horizon. Now, the dollar index has taken a hit, dropping to its lowest level since January, while major currencies like the British pound and the Japanese yen have rallied in response. But what does this mean for bonds, gold, and of course the broader stock market? Could we be seeing a major shift in market sentiment? Are we heading into new challenges? Well, to help us unpack these developments and what they mean for our portfolio, I'm joined by Chris Vermeulen. He's the founder and chief investment officer at the Technical Traders. Chris, welcome back to the show. What a crazy day it's been. The markets are liking this news from Jackson Hole, it looks like.
Yeah, I mean, I think the markets have already been anticipating it. We've seen a very sharp rally, but typically when the Fed cuts rates or talks about cutting rates, we tend to see the stock market rally because lower rates means companies have less debt to service, or it's easier to service, which means better share prices. So it's good news for the stock market.
Yeah, it's certainly good news. Market almost anticipating at this point now. I guess the question is how many rate cuts. Before we get into that, though, what we have seen is some interesting projections on the bond market. I mean, Powell's been signaling that these rate cuts are imminent. There's been a boost in the bond markets, particularly TLT, which you've noticed in a new bullish uptrend after a tough few years. Talk to me a little bit about this. How do you see this trend evolving now that Powell has confirmed the Fed's dovish turn?
Yeah, so I mean, I'm a technical trader, so I don't follow the news. I don't put any of that into any of my trading or investing, but I follow the charts, and the charts tend to lead the news because there is smart money out there and savvy investors more or less front run the idea of what's going to happen. If we take a look actually at the TLT chart, you can see here, this goes back to the COVID spike that we saw. TLT dropped 53, almost 54% for investors, which is devastating for a lot of people most people hold a lot of bonds in their portfolio, whether it's 60 or 40%. It's usually a heavy weighting. People have been annihilated with the drop in bonds. But what's really interesting here is these blue down lines that we see. These are waves of people moving out of the space. And this is like people distribution selling. This is steady outflows of the bond market, driving it down. But what's really interesting is this white line that's curved. This is a very simple signature pattern. There's 3 surges to a low that happened over the past year. And this signifies that the market is actually starting to put in a bottom. That coupled with volume starting to increase, the underlying technicals of the stock market and of the interest rate, the bond market, all these things are coming together. And bonds actually just in the past week generated or started a new bull market based on my analysis. And of course, this is before the Fed came out to say this, because the market generally knows what's going to happen before the news comes out. News is old news, as they say. That's how I see bonds. And bonds are going to be an opportunity, I think, this time around versus, in the last few years, bonds and stocks fell together, which has hurt a lot of people.
Yeah, you mentioned it. I mean, usually the market's forefront, this news, they start forerunning it way before we even report on it. But I mean, you're looking at this, you're obviously buying the dip, but what's the uptrend here? I mean, do you think it can sustain itself? How high is this going to go?
I think bonds have got potential to rally, 15, 20% fairly easily. Wow. We've seen pullbacks of 20% in the past many, many times, rallies of 20% as well. If you go back over the last, 20 years, it happens actually fairly frequently. So I think we could see an easy 20% move in the price of bonds. And then I do think we're probably going to see potentially multiple years of bonds moving up or at least holding their value, because I think rates are going to go down and then kind of flounder. I don't think they're going to go down a lot, but they're going to go down, and that'll keep the bond price lifted and elevated. The question is, how far are they going to go? I don't think they're going to go to like zero interest rates again, but I think there's some pretty good upside in the bond market.
Yeah, it's so interesting. I just certainly don't think that they're going to go to that 0.2, but we've seen a year for these safe havens. I mean, we're talking about gold as well. What a year it's been. It's rallying a little bit today. I mean, you identified that there's a target of $2,700 for gold. Gold futures are trading at session highs following Powell's comments. So are we going to hit this 2,700 level sooner than expected? And what should traders watch out for as gold approaches this level here?
Yeah, so what's interesting, and bonds have been out of favor for years. Gold has been now on a tear. It really has been the play for the last several months. And you and I actually talked several months ago, and I was talking about, I think gold the long-term picture of gold going back 20 years actually has been pointing to 2,700. I actually on this chart have several things lined up here based on the last major super cycle low in the price of gold back in early 2000 to the 2011, 2012 market top, and then back down. This move based on technical analysis using Fibonacci extension, which sounds complicated, but it's not, points to $2,700 an ounce. So this is something I've been looking at and been expecting for a long time. But this is like a 12-year, this was a 12-year bull market, a 12-year cycle. And here we are, 2024. This is the next 12-year cycle coming to play. And we're about to get up to 2,700. I think we're 1 or 2 months away tops from gold hitting that. So we are very close. I think it's on its way right now. And when we look at the shorter term price action, which is the white line here, this is just the shorter term price pattern, a bull flag pattern. It also points to about 2660 or so. So right now, gold is on a tear. Even when we drop down to the daily chart pattern also points to 2,700. So there's 3 different major time frames, 3 different chart patterns, all pointing to it. And it really is kind of like the lowest risk, highest opportunity play in terms of the odds of it working are very well, are very good. We've been, talking about this for many months, and I think we're going to hit it. Now, the question is, when we hit 27, all bets are off. That is the long-term 12-year cycle coming to play, and the stock market might have a big correction. Gold might have a big correction. In fact, this pause that we saw back before 2008 financial crisis, there was a multi-year pause. Right after that, we saw everybody pile into gold just before the financial collapse in the economy topped. And then gold pulled back 34%. Well, we just had that right now. We just had a multi-year pause, and now everybody's piling into gold as that defensive play. And we're almost at the target. And then I think we go into a potential recession bear market, and it'll pull gold down potentially 15, 20, or 30% again. And then it's going to be queued up for the ultimate precious metal rally, very similar to that of 2009, where it's a multi-year run. We see gold, precious metals, and miners scream higher. So I'm bullish short term, super bullish long term, but there's going to be a pullback along that way first.
So you're anticipating this sharp pullback. From the technicals, like what are the signs traders should be looking for, knowing that this pullback is imminent? I mean, we've been seeing a lot of profit taking, but what else can we look at here, Chris?
I mean, when it comes to the gold market, I think when the stock market starts to sell off and we start to see a lot of fear and a level of fear that actually starts to pull gold down with it, because typically when there's fear, we see gold go higher. People move to that defensive play. But when there's enough fear, too much fear, people liquidate everything because they're just scared. They don't know what to do. They don't like the pain. So they will start to sell gold. So if we see the stock market fall with a lot of volume, gold could follow suit with that. And that'll be an early warning sign that, hey, there's real selling going on. The masses are starting to panic out of positions. And that could be the start of a pretty big slide for the gold and the equities markets.
Yeah, so the equities come after. Okay, when it comes to SPY index, for instance, like you've mentioned that current technicals and the sentiment indicators resembled those just before the 2022 bear market, with Powell's dovish stance. How does this change your outlook? I mean, are we at the continued rally, or is this more of a calm before another downturn?
Yeah, I think there's a little bit more upside left in the equities markets. When we look at the weekly chart of the SPY, which I have pulled up here, this is just simple trend analysis on the charts. We have, rising tide environment. We're going to have a falling tide environment. More or less where we are right now, this blue box on the hard right edge, this is very similar to the blue box that happened right in January of 2022, just before we went off, started a bear market of 27% in the stock market to the downside. So the underlying technicals on the long-term charts telling us money flow is actually still moving out. It's moving into defensive plays like gold. We're seeing other assets like energy stocks are still trading near all-time highs. We're seeing industrials trading near all-time highs. Real estate ETF are moving up as a defensive play. Big money is trying to move away from the overall stock market, and they're trying to go to commodity or real estate. They're trying to go to different pockets to protect themselves. And when that happens, and we see this over and over again, those 3 pockets specifically tend to do well and move higher when the stock market will eventually start to roll over. Yet those three asset classes will keep moving. So that's where we are right now. We're in this like late stage. I believe we only have like a month or two left, I think. The stock market, I think, can claw its way up another 3 or 5%. NVIDIA actually has potential to run about 25% from where it is. It has a very strong chart pattern. And if NVIDIA rallies 25%, it's going to drag the major indexes up with it. So short term, I'm bullish, but long term, the weekly chart is saying, hey, get ready. We are having a technical breakdown behind the scenes, under the hood of the market for another 2022 correction or worse.
Right. So what are you setting up here? I mean, are there specific setups or trades that you're focusing on in this environment where we could just see a 3-month movement and capitalize on those 3 months?
Yeah, I mean, we're long the indexes here. We are long gold miners. We're long real estate. We are long industrials, the sector ETFs. I only focus on ETFs myself. So we are long the markets, and I believe we're going to see hopefully the markets run for several weeks, hit some of our targets, allow us to eliminate our risk by moving our stops up. But we're long this market. It really has been telling us that the short-term technicals are strong right now. And they were signaling us, along with the price of bonds, have been telling us the Fed is going to be talking about cutting rates, or they're not going to raise them at least. And so all these things are bullish short-term. Today we get the news, and now we're seeing stocks try to pop and move. And it's going to take a couple of days for the market to digest the Fed. But overall, we're looking at higher pricing for a few more weeks, or potentially, as you said, maybe a couple of months. I don't think it's a big upside potential. It'll be a grind, but there is some upside.
Yeah, people keeping a close eye as well as us. All right, Chris Vermeulen, founder and chief investment officer at the Technical Traders, breaking it down for us today. Hey, thanks, buddy. I always appreciate you coming on and breaking this down.
Yeah, thanks, Jeremy. Pleasure.
See you soon. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for tuning in. We got more on the Fed, so stay tuned, and we'll see you next time.